Gavin McMaster here from Options Trading IQ. And what if I told you didn't need a massive amount of capital to trade options? Today I'm going to show you the exact strategies that you can use to trade options with a small account. These aren't just theory either. These are real strategies, and some of these I will use every single day. So let's dive in. Just a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So let's talk about why most small account traders fail. Mainly because they're buying options instead of selling them. Some of you may have seen this sort of image before, and this represents the amount of time decay of an option. And you can see that it decays steadily over time, and then within the last 30 days or so, that time decay starts to pick up speed. And this is where option sellers can really excel, albeit added risks when we get into the last week or two of expiration. So a lot of times the best area to be when we're selling options is around this 60 to 30 day mark, even around 21 days. Once we get below 21 days, it starts to get a bit riskier. Everything with options is a trade-off. We get that high time decay with those short-term options, but we have high gamma as well. But this is how we can create an edge when we're selling options rather than buying them and having that time decay work in our favor. So why should we sell options? Here's what makes selling options different. Time decay works for you. We can profit from other traders' FOMO or fear of missing out. You don't need perfect timing, and consistent small wins add up. And the other point I'll add here is typically options are overpriced because of something called the volatility risk premium, which I'll do another video on at some point. So the first strategy we're going to look at today is credit spreads. Here's what makes them perfect for small accounts. They are defined risk. So we always know that worst case scenario, we know how much we could potentially lose, rather than naked options where there's unlimited risk. They can be done with a very low capital requirement, in some cases just a couple of $100s. We can set them up so that they have a very high probability of profit as well. So let's take a look. So the first trade we're going to look at is a bull put spread. This is a credit spread on Apple for the May expiration. What we're doing is we're selling one of the 200 strike puts and we're buying one of the 195 strike puts, and that creates a bull put spread. Our short strike is around a 15 delta, so 17 delta in this case. That's a good level to start for beginners. It basically puts this short strike outside the expected move, and that's a really smart place to put your trades. We receive $267 roughly for selling that put, and we pay $193 roughly for buying that put. The net difference is about $75, and that's the credit that we receive when we enter the trade. And you can see that here on our option payoff graph. The maximum profit is $75. The maximum risk in the trade is the difference between the strikes. So we've got a $5 difference here. So that equals $500 less the premium received, gives us maximum risk of $425. And this purple line is our T+0 line. So 75 over 425 gives us a roughly 17.5% profit potential on this particular trade. So you can see for small accounts, we can do this with a very little amount of capital. $425 is our maximum risk. Now let's look at another example. Now in this example, we're looking at a similar idea on SPY. We're doing a bull put spread. We're selling at the closer in strike. We're buying the further away strike, putting that short strike at a 15 delta. Now you can see here we've only gone $2 wide. We're receiving about $20 in premium, and we've only got maximum risk of $180. Now $20 isn't a whole lot of profit, and some of that's going to get eaten up by commissions. But if you're a brand new trader, this could be a good way to do a little test trade just to get used to the process of entering trades and seeing what happens in your account. Very, very nice little test trade that can be done while risking less than $200. Now, getting into the trade is the easy part. The trade management is a little bit harder, but I'll cover that in a different video. Let's look at strategy number 2, high probability iron condors. They're a great strategy for range-bound markets. They're great to enter when implied volatility is high. The reason being, when implied volatility is really high, option premiums are high. That 15 delta strike that we're looking at is further away from the stock price. You can get 2 lots of premium for the price of 1, and I'll show you what I mean in a minute. They're quite easy to adjust once you get the hang of it. So if we go back to Apple bull put spread, change our expiration date to May, what we're going to do is we're going to add a bear call spread, which is another type of credit spread, and we're going to turn this into an iron condor. There's our strike that's closest to the 15 delta, so we use that. We'll keep it 5 points wide as well, $5 wide to keep it consistent. We're going to receive $176 for selling that strike, and we're going to pay $111 for buying that strike. So we're going to get a credit of about $65. And you can see now our overall profit potential has increased to about $130, $135 in total, and our capital at risk has actually decreased because both spreads are $5 wide. So our maximum risk is $500 less the premium received. Because we're getting 2 lots of premium now, we're receiving more premium, about $135. Our maximum risk is about $360, $365. So it's actually reduced our maximum risk. So again, you're doing this trade with just a couple of $100. Very, very easy to enter and a great strategy for smaller accounts. Strategy number 3 is the poor man's covered call. And this is my secret weapon for small accounts. Traditional covered calls require a lot of capital, but the poor man's covered call can be done for a fraction of the cost. And how we do it is we buy a long-term in-the-money call and we sell monthly calls against it. So instead of buying 100 shares, we're buying a long-term in-the-money call, and we call that our stock replacement strategy, where we're buying a call option instead of buying the shares, and we can do that much, much cheaper. So let's go and take a look. Let's use Wells Fargo as our example. So I'm going to add in the stock here, isolate Wells Fargo. If we were to do a traditional covered call, we would have to buy 100 shares. That's going to cost us about $7,150. That's not feasible for a lot of small account holders, and it's going to mean a large proportion of your account is assigned or exposed to this one particular stock. Then what we would do with the standard covered call, we would come and sell a monthly call against it. This is only a couple of weeks to expiration, but we could sell that slightly out of the money, say the 75 strike. We would receive $128 in premium, and that's our payoff graph. We've got a return potential of nearly $500, but we've still got a lot of risk on the downside. We're still risking $7,150. So let's have a look at how we can do that with an in-the-money call option instead and significantly reduce the capital requirements. I usually go out about a year if I can, and I want to buy an in-the-money call option, usually at around that 70 delta or maybe a 65 delta, sometimes even a 60 delta if I want to reduce the cost even further. So what I'm going to do to show you an example of using less capital, I'm going to use the 60 delta. And that option, if we buy that instead of buying the shares, that's going to cost us about $1,000. So much less than the $7,000 that it was costing us before. The main difference here is we're giving up a little bit of profit on the upside. So it turns it into what's called a diagonal spread. Let's have a look at what it would look like if we use that higher delta of about a 70. And let's use a 74 delta just to show a bigger difference. So still not bad. We're only paying $1,450, and risk graph looks a lot more similar to a covered call now. So it doesn't matter what happens in this scenario. Wells Fargo can go to zero. The most we lose is about $1,300. The amount we bought this one less the amount that we received for this one. Whereas if we do a traditional covered call, and yes, it's fairly unlikely Wells Fargo is going to go to zero, but if it does, we're going to lose over $7,000 in this example. Now, the one thing you need to be careful of with poor man's covered calls is that you're basically taking on leverage. So you don't want to take on too many positions like this because you can overexpose your account. So just keep that in mind. Even with great strategies, risk management is key when trading with a small account. Here's how to protect your capital. Number 1, position sizing. Make sure you risk no more than 2 to 5% of your account on a single trade. So that's very important for small account holders. Number 2, avoid over leverage. Don't trade too many contracts. Start small and scale up as you gain more experience and knowledge. Use stop losses and alerts. So one way to do that is to set price alerts for the underlying stock price, and also have your exit plans in place on when you're going to get out of the trade. Number 4 is to diversify trades, spread risk across different strategies, different expiration dates, and different underlying stocks. You don't want to be overexposed to one particular sector of the market. It is very, very important in terms of risk management. Small accounts don't really have the luxury of big drawdowns because it can be very hard to recover from. So risk management should always be number 1 priority. In conclusion, trading options with a small account is all about efficiency, defined risk, and maximizing returns with limited capital. Start small and let time decay and probabilities work in your favor. Make sure to check out all the resources in the description below. Reach out anytime with questions, and have a great day.